Next question. XY Limited, a cement manufacturing company, has hired you as a financial consultant of the company. The cement industry has been very stable for some time, and the cement companies SK Ltd and AS Ltd are similar in the size and have similar product market mix characteristics. So basically, we understand that say these two companies are proxy firm for XY Limited. They are doing similar business as what XY Limited is doing. We understand that say it is of the similar size and they have the same kind of the product mix. Use comparable method to value the equity of XY Limited. In performing the analysis, use the following ratios. So we are required to do the valuation using the market to book value approach. Market to replacement cost means if at all we build such company once again, then in that case what would be the cost. Market to sales, market to net income. Market to net income is same as the price earning ratio. The following data are available for your analysis. So the information is provided to us with respect to the market value, book value, replacement cost, sales and net income of SK Limited and AS Limited, and the company which is under valuation, that is XY Limited. I request all of you to go through the question, please. Dear students, over here, as per the given information, we can very well understand that say we are required to do the valuation of XY Limited using the market to book value approach. So it's very simple. See what will happen, 450 divided by 400. So that ratio comes to 1.125. Then 450 divided by 600. That comes to 0.75. Then 450 upon 550. That comes to 0.8182. Then 450 upon 18. That comes to 25. So using this ratios and this value of XY Limited, which is under the valuation, we'll get the value of the XY Limited using SK Limited, using AS Limited, and then what we are required to do, we understand that say using the book value approach, we get the two values. We'll do average in a way that say the simply we understand that say the equal importance is given to both the companies. Using this again you do average, using this again you do average, using this again you do average. Like that say 4 times valuation is made and then we do average of all 4 of them. And that is what say we understand is the valuation of the XY Limited. So write down answer the question. In this question, using proxy firm information, comma, we have to compute value of equity. Okay. So let us see method. Then SK, AS, and then total. And next column I'll do average. I'm sorry, we may not do the total, we'll do the average directly. See, the first is the market value approach. Sorry, book value used. In that we understand it is 450 divided by 400. So you'll get the ratio as 1.125 something multiplied with 250. For AS it will be 400 divided by 300 into 250. That is the way we are supposed to make the calculation. Same way, it is the replacement cost. In case of the replacement cost, again, it is 450 upon 600. It means that the market value is 75 paise of the 1 rupee of the replacement cost multiplied with 500. The next one is 400 upon 550 multiplied with again 500. Next is the revenue, that is the sales. For the sales it will be 450 divided by 550 multiplied with 500. And for AS Limited it is 400 divided by 450. So you'll get a ratio multiplied with 500. Next, net income. In that it is 450 upon 18 multiplied with 14. For AS Limited it is 400 upon 16 into 14. That is the way we are supposed to do the calculation. So basically what happens that this is a kind of a ratio multiplied with the book value of the XY Limited which is under consideration. Again this is a kind of ratio multiplied with the book value of XY Limited which is there in the question. This is the way we are required to do answer. So we'll do first of all average of this 4, and then whatever the total that we get, again for that the average will be done. And that is what's the value of XY Limited. We understand that we have taken certain quantifiable measures for valuation of the company. So the answer will be 450 divided by 400, 1.125 into 250. That is 281.25. divided by 600 into 500. That is 375. 450 divided by 550 into 500. That is 409.09. 450 divided by 18 into 14. That comes to 350. So 281.25. Okay. Sorry, the next one is 400 divided by 300 into 250. That comes to 333.33. So it is 281.25 plus 333 will make the total divided by 2. 307.29. $400 divided by 550 into 500. That is 363.64. 375 plus 363.64, 738.64 divided by 2, that is 369.32. Next, 400 divided by 450 into 500, that comes to 444.44. 409.09 plus 444.44, 853.53 divided by 2, so 427, 6.77. Next, 400 upon 16 into 14, that comes to 350. So 350 plus 350 divided by 2, that comes to 350 once again. So summation 307.29 plus 369.32 plus 426.77 plus 350, that comes to 1453.38 divided by 4, that comes to 363.35. This is the way we'll make the calculation of value of the equity. This is the way the value of the equity is calculated, say using the proxy firm information.